Talk 1, 2.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning. Welcome to the show. I heard a noise in the background. Good morning, welcome to the show. Of course, it is the second best day of the week. Michael Lebowitz joining us today to talk a little bit about everything economic, Fed, etc. We'll get into all that this morning with him. Specifically, we're going to talk a little bit about the Atlanta Fed, and lots of headlines lately about the Atlanta Fed, GDP Now report, etc. So we'll get into some of that this morning versus what the other economic data is telling us, and try to get down to what's really kind of the concern looking forward. The risk of recession, is it really there? Is it not? We'll get into that this morning to a degree with Michael. His article on the website right now, realinvestmentadvice.com, as always. Yesterday, of course, the big news is that more tariffs. Again, as we've talked about before, the big problem for markets is this kind of day-to-day flux about what tariffs are and where they're going to be. And now we get some conversation about, well, maybe there'll be reciprocal tariffs, but it won't be real tariffs, and there'll be sort of tariffs, and then, but we're going to put tariffs on autos, but if the EU and Canada work against us, we're going to put more tariffs on them. That flux is just driving the markets insane right now because, again, as we talked about yesterday, you can't price earnings for this. So when you're talking about forward expectations, if I don't know what the E is or what the E is going to be, it's really hard to determine what price to pay today, right? That's how we get to a valuation measure. Why are valuations important? It's because what we're willing to pay for a set of earnings. But if we don't know what the E is, then it's hard to figure out what the P should be, and that's why markets are going through this flux. But that makes it very difficult to invest in markets. It certainly weighs on investor sentiment. We've seen a very sharp decrease, of course, in the American Association of Investors. Their bearish sentiment has risen sharply, but I thought one of the more interesting ones was just day before yesterday, the Conference Board came out with the Conference Board Consumer Confidence Index. One of the measures in there, and that measures a lot of stuff, right? It measures your expectation for incomes, which, by the way, has dropped sharply. Your expectation for having a job next year has dropped sharply. So consumers are certainly becoming a lot less confident in the overall economic environment that we're in. But the most interesting one I thought was, of course, the outlook for stock prices. Now, you'll remember that we talked about this previously, and I showed you some charts on this a couple of months ago. Even though the consumer confidence about the economy, about jobs, about incomes were dropping, their expectation for higher stock prices was at a record, highest level ever on record. Well, just 2 months later and having a 10% correction, that has now had the largest drop ever on record, right? So now consumers are no longer confident about higher stock prices. Now they're expecting lower stock prices. So again, just massive swings in sentiment. Even though we've just had this kind of minor decline in the markets, it's really impacted the consumer confidence and investor confidence as well. All of that's very negative. The CNN fear greed gauge, very much in fear mode. We're just seeing this professional investors, underweight equities, etc. So again, this decline has had a real psychological impact, and a lot of that has to do with this economic policy uncertainty. And again, as I said before, if Trump would just come out and say, look, we're just going to make this really simple. We're going to put 25% tariffs on everybody starting tomorrow, and that's it. We're not going to change it. That's just the way it's going to be, so live with it. The markets could adopt for that very quickly, right? Economic policy uncertainty would not be screaming higher, but it's this on-again, off-again problem that's sending this economic policy uncertainty to highs and certainly weighing on market outlooks. Okay. So having said all that, we did have some action yesterday in the markets we do need to talk about because it's important, right? We'll get into that. So here's what you need to know before the bell this morning. Big news headlines, of course, yesterday. This tariff issue, auto tariff issue was coming out. Markets sold off ahead of those auto tariffs. They were announced after the bell yesterday, so 25% tariffs on foreign automakers. So this is certainly going to impact countries like Japan, China, etc., that import cars into America. So if you're going to buy a non-American made car, it's going to cost you 25% more with this tariff. That certainly weighed on the markets, and we saw the market reverse yesterday fairly sharply, really a drag all day long. It wasn't a sharp reversal at all. It was just a slow sell-off all day long yesterday. So two things about this now that are important. First of all, we did fail at the 200-day moving average. So again, the media alarms kind of go up here. It's like, oh my gosh, we failed the 200-day moving average. Time to get out of the markets. Be a little cautious with that, particularly when you have a day that was driven by a news headline. We need to see how this plays out. So give this a day or two here. You know, this market is could rally this morning. Futures are pointing up, mildly, very weakly this morning, but we are seeing a little bit of improvement in futures. So give this a moment here to confirm that this break is valid. We've seen these kinds of breaks before, and they turn around and reverse, and they start to go higher. So again, just want to give this a little bit of a confirmation here first. But, we have this kind of rising trend line or trend channel right now in the markets coming off this bottom. If we do violate this kind of trend channel, then yes, this is going to be much more concerning. Probably need to start talking about reducing risk a bit more here. This was potentially that sellable rally that we talked about. It's unfortunate that's maybe all we get out of it, but we'll have to see what happens here. But be a little bit cautious, overreacting here just at the moment. Again, we're not going to give this a big leash, but we'll give it a little bit of a leash here to see if the markets can kind of muster up. Because also, too, we're still in the end of the quarter rebalancing period. There's a lot of buying that needs to get done between now and next Monday. So, again, just want to give this a little bit of breathing room here just to confirm that yesterday's sell-off was more than just a headline-driven event. Also, too, we're still on a buy signal here from a decently oversold level. Relative strength is improving. So, again, that's a couple of reasons here. And also money flows remain positive. So, again, just a couple of reasons that we may see a little bit of buying support in here as we start to head in the end of the month. Again, but technically this was not a good day yesterday. For a lot of reasons, not a great day yesterday for the markets. But if you think it's bad in the S&P 500, I just thought I'd show you a quick look at what's happening in the Russell 2000 index. This has been a complete train wreck now going all the way back to December. There's been no real kind of pickup here at all for small cap and mid cap stocks. This really kind of runs across the board. Here's just mid cap by itself, the S&P, just the S&P 500 mid cap stocks under tremendous pressure here. So really outside of large cap stocks, and it's primarily been the value stocks. We've seen this rotation into value stocks over the course of the last couple of months in particular, and that's what's been helping hold up the S&P a bit better. But certainly not the case for small and mid caps. They're certainly being weighed on by reduced expectations. While we're still seeing earnings expectations rise for the S&P 500, earnings expectations for mid caps and small caps are absolutely flat. There's just no expectation of growth right there. And that really is a reflection of much slower economic growth coming out of the economy, which is also disinflationary to a large degree. So again, there are certainly negative pressures to the markets. Those are starting to feed into the S&P 500, and I don't want to, negate the importance of kind of technically what's happening here. But again, at the same time, we don't want to go take, big tradable risk in our portfolio by going completely risk off, whatever it is, make drastic changes based on one day's move. This is something to pay attention to. And if this starts to confirm itself, we need to start taking some action, but those actions will be slow in nature. Again, you don't want to try to just make drastic moves in your portfolios all at once. Those tend to turn out to be mistakes. So again, just kind of pay attention to this. We'll keep you updated as we go. Of course, we'll cover this more in our weekend newsletter as well. But again, we'll keep that's what you need to know before the bell this morning. We'll come back, pick up with Michael Lebowitz, talk about GDP Now. Is it really telling us there's a recession? Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Of course, it is Thursday, And that means Michael Lebowitz joining us this morning. Michael, good morning. Welcome to the show.
Good morning. Good to be back.
Yeah.
It's been a while.
That's right. You were out last week. I totally forgot. We didn't miss you at all.
And you were out the week before.
So, see, nobody missed me either. It was all good. So a couple of things, again, I just kind of want to touch on kind of what happened yesterday. Obviously, markets kind of sold off here again. We kind of failed at the 200-day moving average. Obviously a concern. Lots of headlines out right now. This is kind of bear porn, Nirvana right now. If you've been bearish the market, this is the headline you're looking for. But one thing is that historically, going back over the very, very long term, if you had sold the 200-day moving average breaks, you actually did pretty well with it. But that hasn't really been the case over the last 15 years because of all this monetary intervention and things that are going on, all this kind of computerized trading access to markets. Is that breaks of the 200-day moving average have often been where you should be buying and not selling, at least over the last 15 years. That's pretty much been the case. Even during 2020, that break of the 200-day moving average, was quickly recovered. It took a function of about a month before it was back above the 200-day moving average, and we were moving off towards new highs. So again, just it's been a very different environment. But do you have any particular takeaways from that?
Yeah, the hard part about this, we're flirting with the 200, flirting just underneath the 200-day moving average, and it's quarter end. And on top of that, we have news, like you talked about, these tariffs are on again, off again. So the combination makes it really hard to assess the technical 200-day moving average. Why is it below it? And is quarter end can create some very extreme volatile events that end up just working themselves out, and you start where you end. But there's a lot of ups and downs because mutual funds have to rebalance, hedge funds rebalance, retail money managers rebalance, meaning they sell some of the things that are working and buy some of the things that weren't working to get their proportions, their ratios back up to normal. Mm-hmm. So it's going to be incredibly difficult here to assess the market over the next couple of days with the 200-day right in sight. Typically we like to look at month end and weekends. Well, this weekend is also not the month end. The quarter end is actually Monday. So, we also have to balance that. It's going to be, it's a little trickier than normal, and then of course, on again, off again tariffs. Mm-hmm. And April 2nd, so you get past March 31st, quarter end, and then you got April 2nd, the Liberation Day. Right. And that's when the tariffs are all going to hit the market. And, there's a school of thought that Trump's going to be be light on tariffs. And then there's other schools that think he's going to be really hard because that's his bargaining chip. Right. So if he comes out light, he loses some of his, not that he can't come back and go harder, but so far from what we've seen from round two of President Trump is he likes to hit hard and then ease off. So one of my concerns is that April 2nd could be a tougher day for the markets. And, who knows where we'll be in relation to the 200-day on April 2nd. Yeah. No, and it's a good point. And this is what I was saying earlier. I mean, the markets have a really tough time evaluating the E when, you don't really know what these tariffs are going to be. And, if he would just come out and just say, look, we're putting 25% tariffs on everybody, go away, leave me alone about it. This is the way it's going to be. The markets could adapt to that, right? The economy would adapt to it. The markets would adapt, consumers would adapt to it. But, what happens is now with this kind of on again, off again thing is we keep getting these spikes in, like durable goods yesterday was a good example of that, right? So we've got these more tariffs coming April 2nd. So we saw this big spike in durable goods orders, people trying to get ahead of those tariffs. We've talked about the gold imports, trying to get ahead of the tariffs. Which is going to feed into one of our conversations this morning, talking about GDP Now. But we're seeing all these anomalies in the data, which makes it extremely difficult to really figure out how to invest or where to invest. Because again, this could all end tomorrow. I mean, he could come out tomorrow
and say, you know what, I've changed my mind. I'm taking all the tariffs off because everybody agreed to better terms with us, right? And so now we got to reverse everything that we just did. That's the risk to the markets. And this is what we talked about really coming in the beginning of this year. We wrote this article called Curb Your Enthusiasm and said, just because of all this different stuff, expect a lot of volatility. We may not go anywhere this year, just maybe a lot of ups and downs. And so far, that's kind of been the case, and that doesn't seem to be alleviating itself anymore, at least right now.
And Lance, the other thing that makes this hard is the industries. The auto industry is a great example. It's getting hit with a 25% tariffs on all imports. Well, what does that mean? Your gut may say that Ford and GM are now in a great place. Toyota and Honda are not. But I believe Honda is the USA's largest producer of cars, believe it or not. And then you have to deal with the importing of those goods that make up the car. And it's really hard to assess stocks when you don't really have enough information, and the type of tariffs are changing all the time. So for instance, if you look at the market this morning, Ford and GM and Honda and Toyota are all down about the same. They're all equally affected. Tesla's up a hair, but it was down 5 or 6% yesterday. Mm-hmm. So it's not just hard from a very macro level, what's the big S&P 500 doing and all the other industries in it, but how's it affecting the individual stocks and what you do own.
Yeah, that's right. And again, that's the hard part about cars is that, in particular, is that there's so many foreign-made parts in even Ford and GM cars, right? So just because the cars says Ford or GM and it's GM's American-made, there's still a lot of foreign parts in that. So are you just tariffing the parts, or are you tariffing the whole car? I mean, this can get very complicated very quick. And to your point, if Toyota's got a huge manufacturing plant, I think in Tennessee, where they assemble cars here. So is it assembled cars, or is it actually manufactured cars where the parts are manufactured? Is it a certain percentage of the car that's made from foreign parts that makes it a foreign? This is why it gets very difficult very quick, right? And I think that's going to become more challenging as we start to try to move forward with these tariffs, is actually defining exactly what all that means.
And what's going to happen to the used car market? My guess is if cars truly are more expensive, used cars become in more demand.
And the problem is we've got a huge shortage of used cars because of what we did during the Obama administration, where we were actually destroying used cars. And then, of course, you've had the hurricanes that destroyed a bunch of cars that have taken those off the lots. So there's a big shortage of used cars out there, and we've had this running now ever since COVID. So again, if you create demand for used cars, that price is going to surge because there's just not enough used cars out there to meet demand, and you can't manufacture used cars, right?
Right. And if you're confused, so is everyone else.
Right.
Right. We're just kind of touching on one tariff. On April 2nd, there's going to be tariffs across the board that will, even after April 2nd, they will change. They will be adjusted. They will be gone. They will be doubled in some cases. So this is why the markets are skittish, because it's very hard, like you said, to know what the E is. And when you don't know what the E is, it's hard to put a price on a P.
Well, yeah, and again, this is really, to bring it all back to a point is, look, economic policy, political policy, whatever, we don't have any control over that. We may like it or dislike it, doesn't matter. We just have to deal with it from an investment standpoint, right? From the market standpoint, et cetera. So again, what all this means is regardless of whether you support tariffs or not is irrelevant. What does it mean for the financial markets? And the financial markets are going, I've got to be able to calculate the earnings. And what's that impact going to be? If I'm an auto analyst right now for JP Morgan or Goldman Sachs or whoever, I'm trying to figure out now, well, what does that mean for the companies that I cover? What does that mean for Ford? What does that mean for GM? Does this give them an advantage or not? Or is there a negative impact to the earnings growth for these companies based on these tariffs? And then if it changes tomorrow, I've got to go back and redo all that work again. So, so when it comes to the investing part, this is why markets are just kind of going, hey, just, you know what, I'm out. I'm just going to get out of it for right now and let all this stuff settle down, and then I'll try to pick through the parts. That's kind of what's going on here, is that investors are just backing away from the markets. They're losing confidence in the markets because they can't calculate what these tariffs and what this economic policy actually means for the valuations that people are willing to pay for a set of earnings. So,
and then
go ahead. Go ahead.
I was going to say there's just a whole big macro effect too, inflation and growth and how they interplay off each other, which further makes investing hard.
Well, and that's what we're going to talk about next. When we come back from the break, we'll pick up and talk about GDP Now because, again, if you take a look at GDP Now, it's showing a very negative, about a negative 1.8% growth for GDP. Of course, this had a lot of headlines out. Recession. Atlanta Feds predicting a recession in the economy. Blah blah blah. Michael Lebowitz wrote an article on Wednesday taking a look at the different measures of GDP and what Atlanta Fed is actually telling us, or potentially telling us, versus what may be actually happening in the economy. We'll talk about that when we come back from the break. Don't go away.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
By the way, I'm very disappointed in you and Richard, both.
I can't
very
wait to hear
disappointed.
why.
Because I was online yesterday and got an ad that popped up. And it's for a new book that's just come out. It's called I'm Sorry I'm Dead. That's the name of it.
The Real Investment Show podcast.
So when you pass away, all the people you need to contact. And, we told our kids that when my wife and I pass away, we want them to cremate us and then take us to Italy and dump us in the ocean in Italy.
At realinvestmentadvice.com.
Knowing my kids, I don't trust them. So I may have to have a third party kind of make sure we get to where we're supposed to be.
A trustee of ashes?
Yeah, exactly. We got him as far as Galveston.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
If you're working
and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So lots of headlines just recently talking about the GDP Now, telling us that recession's on the horizon. Atlanta Fed GDP printing a negative 2% economic growth for the first quarter. And Mike and I talked about this a little bit before, but Mike dug in, kind of did some research on it here just recently. And, the thing that we've talked about often is that, the data is lagging. So we're dealing with a lot of lagging economic data. And so the Atlanta Fed kind of catches up with us over time. But I thought it was interesting, Mike, as we're going to talk about this morning to some degree. I thought it was very interesting. The Atlanta Fed just came out with a revised GDP Now graph. Have you seen this graph yet?
Yeah, I have.
Okay.
It's interesting.
Yeah. So one of so before I show anybody the graph, let's talk about kind of what happens, with what was one of the big factors behind the Atlanta Fed's GDP Now initial kind of projection for economic growth, and what was one of the big drivers behind that. And then I'll share this updated graph with everybody. But you kind of tell us a little bit what happened initially.
So when you're going to show the graph in a second, but there's a huge drop in GDP Now, and that's the estimate by the Atlanta Fed for GDP. It's a running estimate, and it dropped from 2.2% to minus 1.8% in one day.
Actually, it was it actually peaked at near 4% at the first estimate when it came out. So we were about 4% positive growth, and then we got some initial data that came in. It went to 3. Then got some data that came in. It was a little bit weaker. It went to 2.5, and then literally in like 2 reports, it went from 2.5% economic growth to negative 2%. It's just this massive plunge, right? But what was the driver behind that? What caused that big drop?
A lot of it was just the trade balance. So part of GDP is the trade balance, and the more of a trade deficit you have, the worse it is for GDP. And what happened was that there was a massive amount of imports. Some of it was gold, and there are reasons for that, and some of it was other goods trying to front run tariffs, right? If you think steel's going to be tariffed at 25% in February, buy as much steel as you can in January and December, right? And I think there was a lot of stockpiling and front running. But there was also a lot of gold being imported or, brought back to the United States, particularly from London. And that too was to avoid tariffs, potential tariffs. Even though tariffs on gold have not been discussed, it's a possibility. So what's interesting is everyone's talking about it, and the numbers are kind of there to see. But the Atlanta Fed, I think it was yesterday, put out what they call a gold adjusted GDP Now.
Yeah, and this is the chart. So 2 things real quick to make this clear. The amount of gold imports to get ahead of tariffs was absolutely massive, and it was a major contributor to that decline in the trade deficit. So real quick, just so everybody understands, GDP, the calculation of GDP to get economic growth, GDP is about 68% personal consumption expenditures. It's about 15% business investment. And then you have government spending and then net exports, which is exports minus imports. So that's that trade deficit Mike's talking about. So you had this massive surge in gold imports. And I've actually got a chart on this I can share with you in a minute. But over the last month, you've had this tremendous surge, which has been creating this very big drop in the actual trade deficit due to these imports. And so the Atlanta Fed, as Mike's talking about here, just adjusted it and to show the impact of those gold imports. So again, instead of negative 2% growth, that 2% drop in GDP was all related to gold imports, trying to get ahead of tariffs. And so if you take those gold imports out, economic growth is just above zero. It's running about 0.5% growth. Still not great, right? But it's not this big recessionary number. And again, this number is going to improve. And this is where we're going to get back to Mike's article, which was out yesterday. So what does this mean? So again, we talk about the Atlanta Fed. They're taking data in real time, and they're just calculating based on this data that they're getting, where other measures of economic growth are using kind of a running estimate of economics and the trend of growth in those other economic pieces of data. So the Atlanta Fed is very volatile, and it gets closer to reality as you start getting into April, when it can actually have the March data. It's still missing entire months of data and only about half a month of February that they don't have yet of the Atlanta Fed. So a lot of that data is still coming in, and over the next month and a half, economic growth the Atlanta Fed will get closer to what the actual economic growth rate is. But Mike, you did a chart looking at several different measures of economic growth, and what is that telling us versus the Atlanta Fed?
Yeah, so there's kind of two models that the Fed uses and Wall Street economists. One is the GDP Now, that's by the Atlanta Fed. And what that does is it solely uses what the BEA uses to calculate GDP. So whatever those inputs are,
Mike, real quick.
Whatever
BEA,
those inputs are, they're the same.
Mike, hold on real quick. You're throwing out a lot of acronyms for people. The BEA is the Bureau of Economic Analysis. That is the government organization that actually produces the GDP number, the official one. It's like the Bureau of Labor Statistics for labor. Go ahead, Mike.
Exactly. So the GDP Now model uses only those inputs. And that's one reason why the trade balance had such a big effect. It came out in mid-February. So if you think about it, you're just starting to get data for January in February. So it's one of the first pieces of data. And what the GDP Now does is just use what they have. They take the ending GDP from the last quarter, and then they adjust it based on data as it comes out. So when there's very little data, big numbers that are kind of out of whack can have a big effect on their forecast. But bear in mind that with every new number that comes out, the forecast gets refined and it becomes better as the data becomes more complete. Nowcast looks at not just the BEA data, the GDP data, but all data. Not all data, but a lot more data. And they regress. They use statistical analysis. So here's a great example. Retail sales. Within the retail sales number is something called the Retail Sales Control Group. And the Retail Sales Control Group only excludes a few things. One of them, for instance, is gasoline sales. So GDP Now will exclude gasoline sales. The Nowcast models, the other models, will say, okay, gasoline sales are not in GDP, but gasoline sales have a huge correlation with people driving. So people drive to work, and it has a big predictive ability on the economy. So they'll use gasoline sales. And what we find when you compare the two, as you're shown in the graph, is that they're both wrong. You know, they both have decent margins of error, but they both do an okay job of predicting the economy. And, you know, Lance, one thing we've said is that giving me one number for the inflation rate's impossible. Mm-hmm. GDP is equally impossible. It's we're such a massive company with so many inputs and outputs, and it's so complicated. Trying to actually pin a GDP number on the country is impossible. Then you're trying to predict what that GDP number is even harder. But these are the two models, and they both help us immensely. And look, GDP Now was minus 2 point something percent. We knew that the economy wasn't running at minus 2%. the market knew it. The market would have been down much more than it was if the market really thought the economy had gone into, minus 2+% would be a deep recession. So, you take these numbers with a grain of salt, but you also understand what's in them and what it means. And when you merge the two together, it's very helpful.
Right. And again, this is, kind of the thing that we warn about a lot is be careful of these headlines, and particularly when they come out of, the media, et cetera, because again, they're looking for, something to get clicks and views and those type of things, which is great. And there's nothing wrong with that, right? But if you're reacting to that type of data and making big portfolio changes, et cetera, based on this data, just understand it's going to change. And again, like the durable goods reports yesterday was decently strong. That's going to feed into improving the GDP Now number when they next update their number, because they don't update it every day. It's updated like once a week or once every couple of weeks. So the next time it gets updated, if we get some stronger economic data, that number is not going to be near zero. It's going to be probably closer to 1, which is about where the other estimates of GDP are now, because they're between 1 and 2%-ish, right? So again, weaker economic growth in the first quarter, absolutely for sure. We're seeing lots of evidence of economic slowdown. We've talked about that's going to be the case this year. We're going to have an economic slowdown at this point, not necessarily a recession. Doesn't rule a recession out at this point, but definitely weaker economic growth as the impact of tariffs and the extraction of monetary liquidity from the markets continues, because we're not doing any more big spending programs. So all that big spending programs, those are still running out of the markets. So economic growth is going to slow back towards its long-term trend, which is around 2%. This is even why the Fed's suggesting right now 1.7, looking for economic growth. So again, that's even below the long-term trend, but that also is going to impact inflation. It's also going to impact unemployment. So those are going to be factors we're paying close attention to as we progress further into the year. Okay, quick break. We'll come back, finish up with Michael Lebowitz. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your question about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Real quick before I get to my next scary headline this morning, I told you I would show you this chart of gold imports into the U.S. We've had 2 months in a row now of record shipments of gold coming in. Now, this is the Swiss exports to the U.S. We're also importing from the U.K. as well to a very large degree. But this is that big spike in gold shipments to get ahead of tariffs is why the trade deficit is so negative right now. So again, once you strip out all those, the trade deficit is much more. We were already running a trade deficit, so again, that's just kind of normal that we have a trade imbalance, which is also one of the reasons that Trump wants to do tariffs. He's trying to fix that trade deficit as well. But this has been exacerbating the trade imbalance because of this massive importation of gold. Because again, remember the input into GDP is net exports. So it's exports minus imports. So you get to the net of just what are you actually exporting. And exportation is very important. That's 40% of corporate revenues, particularly with companies like Apple, Microsoft, others that sell all over the world. That's a very important part. But there is another headline out that you're going to see running around more and more over the next few days. Actually, over the next few weeks, lots of good bear porn coming up because of the potential debt ceiling limit. And already the headline was out yesterday. CBO warns the U.S. could default on its debt. I can't tell you how many times that I've had to address this headline over the last 20 years. We've been running a debt issue ever since 1980, and we have a debt limit that says that we have a debt ceiling, and when we're issuing debt, we can only issue the debt up to that debt ceiling, and so we have to raise the debt ceiling in order to issue more debt. First of all, I think we're up to 28 or 29 times now. That I'll have to go back and get the exact count. Mike, maybe you can correct me, but I think it's 28 or 29 times now that we've had a debt ceiling and we've raised it. And we continue to raise the debt ceiling as we go along. Now, a lot of people want to get rid of the debt ceiling. I get it. Like, if you're not going to pay attention to it, then why have it? But at least it gets people to talk, right? At least we have to have some conversation before we raise the debt ceiling. So at least it's a little bit of a break on government spending. Not a big one, but at least slows down the process long enough to have a conversation about debts and deficits and these type of things. But we're not going to default on our debt. And again, Mike and I have talked about this ad nauseum, is that debt interest payments are mandatory spending. Those get paid first. So when you run into the debt ceiling, the things that get cut off are basically your discretionary spending. So yeah, it's your defense spending, it's your Department of Education, Department of Energy, Department of this, Department of that, public parks, those things. That gets cut because that's all coming out of excess debt issuance. But we don't even get there before the debt ceiling is raised because the Treasury has other options to go to fund spending before we just simply have to issue more debt, and we're required to do that. So again, there's generally some times called emergency measures, and that typically gives you 6 to 8 months of additional spending to give Congress time to raise the debt ceiling, which again always gets done. But Mike, just real quick, here's a chart talking about the X date. The X date is expected to come sometime over the course of the next few months, and that is where we actually hit the debt ceiling. And then this kind of shaded area that goes out to the right through October is the differential between our ability to actually issue debt and emergency measures. So again, you have a bit of runway here, but most importantly, to get back to the beginning of all this, we're not going to default on our debt. The interest payments are going to get made. They always do because they're required. It's mandatory spending. Social Security checks are still going to go out. You're going to see headlines like Social Security recipients are going to lose their payment. No, it's not the case. Because we have revenue that's coming in. We're collecting almost $5 trillion in revenue every year right now through taxes. There's revenue coming in, and we issue the difference in debt. The debt is the issue we have to deal with, but default is not one of them. Mike,
your comments.
I would also add to that, politicians like getting reelected. And
that's also a good point.
That's probably the biggest point, right? Because I think what we just saw was the best example of how this thing is just such a farce, right? The Democrats would love to block Trump on everything possible. And this one, the debt cap that just passed, what was that, a few weeks ago, was one that could have created some problems. It would have shut down the government. And no, Schumer said, we're signing, and he got enough Democrats on board. They signed it and went on. The bottom line is it makes them all look bad. And they all like getting reelected. They all like holding on to their power. So they all, it becomes theatrics, and they make a big to-do out of it, but they always pass. And Lance, I have a new rule. Mm-hmm. So in our daily commentary, we're always, we're looking for stuff to write about. And inevitably, the debt cap every once in a while comes up, and we'll write a couple paragraphs on the debt cap. We're done. No more debt cap in the commentary, Lance.
Well,
until the day after.
Exactly.
If they go the day after, then we'll start talking about it. But until then, it's off limits, all right?
Yeah, I wanted to show you, I don't know if you can see this chart, Mike. There's another kind of, headline that runs around. You've addressed it, more often than not. But it's that foreigners are dumping U.S. Treasuries. And I love this headline because, we've certainly seen some countries reduce their amount of holdings slightly. China has. And that doesn't, there's a far difference between reducing the amount of debt you're currently holding versus dumping treasuries. And again, the headlines are like, oh, nobody wants to own our treasuries anymore. They're dumping them like crazy. This chart is the total holdings of the $29 trillion worth of U.S. debt that is out in the world. And what's important is this big red shaded area in the bottom. That's foreign holdings. And that is so over the last 4 or 5 years, all we've heard is how all these foreigners are dumping all of our assets, yet the total ownership of foreign debt holdings of U.S. Treasuries has been rising. And again, it may be China is selling some of theirs, reducing some of their holdings to balance. And this is all about currency balancing. This is all this is. What is the dollar versus the Chinese yuan? So do I want to have more reserves in U.S. dollars or less reserves in U.S. dollars? And so that's what goes on here, and depends on their economic strength versus our economic strength. China's been very weak as of late. So they're repatriating a lot of their currency into their currency to keep their currency closer in line or closer to a peg of the U.S. dollar, which has been very strong. So a lot of this has been going on is really just currency reserve balancing. And that's all that's happening. But the UK, as a good example, has been a big buyer of U.S. Treasury. So whatever China's selling, the UK has been buying it. So, the point is, and Mike, your comments on this, is that this is another one of those narratives that run around that scare the bejeebers out of people, and that leads them to make bad investment decisions because of something they heard in some piece of news that's not really even actually factually correct.
Right. If China wanted to, they could come out today and what do they have, about $1 trillion? I think they have about $1 trillion of. Yeah. If I were, if you were really trying to send a message, hey, Donald Trump, we're selling 300 billion of U.S. Treasuries today, and if you don't drop every tariff, we're going to sell another 200 billion every day until we don't own anymore. Mm-hmm. You want to create some financial panic? That would do it. They're not doing anything. Their balances are going up and down based on trade and based on their currency versus our currency, and what are they supporting? But at the end of the day, they may be selling a little bit on the margin and buying gold or buying euros or buying oil reserves or whatever they're doing. But they're not even really threatening to sell the dollars, to sell the U.S. Treasuries. They're just moving in line. So again, like you said, Lance, it's like the debt cap. These headlines like GDP Now, right? When it was down 2%, they're bear porn. They're scary. And if you don't know what you're looking at, I can see why you'd want to own all gold, or why you'd want to be out of the stock market, or why you'd never want to own a treasury bond. But when you dig in a little bit, there's a lot more to it. And in all three of those cases, they're factual, I guess, but they're not true, right? They're not really. You learn a lot more when you study them and read just a little bit. It doesn't take much reading to understand what's going on. It's easy to find data. That graph you can find, if you just look up Treasury foreign holdings, you can get the data from the Treasury Department really quickly.
Yeah. And again, this is just the whole issue we talk about a lot, Mike, is you got to do some homework. The problem is today with the media is that there's so much, kind of bias in the media, one way or the other. And again, you've got a lot of people out there that are just, absolute raging bulls and nothing's ever, Tom Lee's a great example. Market's always going up and it's always positive. And then you've got other guys out there that are just super bearish all the time. And, the problem with either one of those cases is that it can lead you to make investment mistakes. And the goal is just trying to navigate kind of what's going on in the markets. And right now we're certainly, in a period of market turmoil. It's very difficult, and this is the time where really bearish headlines get a lot of views because oh man, market's down. Why is it down? I need to rationalize why that's the case. But this is also where we make a lot of mistakes, and that's why we got to be real careful. And that's why we spend the time with you here on the show to go through this data, try to sort this out for you a bit, and at least give you a better kind of a balanced opinion about what this data is actually telling us so we can invest better. That's at least our hope. We hope we're doing a good job for you. And if we are, like and subscribe to our channel. We certainly appreciate that. Get by the website, get our latest blog post. Mike's article out on GDP Now is on the website now, realinvestmentadvice.com. And we'll see you back here tomorrow. Have a great day.
Lance. So I can't see